Welcome to our podcast on ASU 2015-3 and ASU 2015-15 that deal with simplifying the presentation of debt issuance costs. In this podcast, we're going to describe the current U.S. GAAP requirements of the ASUs, we're going to explain what does not change as a result of the ASUs, and we're going to address questions that may arise as the new guidance is adopted. My name is Brandon Schaefer, and joining me in this podcast is Thomas Feneto, and we're both senior managers in KPMG's Department of Professional Practice.
On April 7, 2015, the FASB issued ASU 2015-03, simplifying the presentation of debt issuance costs. As the title of the standard conveys, this project was part of the board's simplification initiative. But before going into the details of this ASU, it probably would be useful to quickly discuss what the current requirements are for debt issuance costs. So, Brandon, could you remind us of the current requirements?
Of course. Under U.S. GAAP, there are generally two types of costs incurred when issuing debt. The first is fees and other costs to the lender, and those are already presented as a direct deduction of the carrying amount of the debt. And then the second is costs paid to third parties, which are currently reported on the balance sheet as assets and amortized as interest expense.
Thanks, Brandon. And so ASU 2015-03 addresses the cost in that second category you just talked about, that is, costs paid to third parties, and the ASU requires these costs related to a recognized debt liability to be presented in the balance sheet as a direct deduction from the carrying amount of that debt liability, which is consistent with debt discounts. The cost will continue to be amortized to interest expense using the effective interest method. Presentation of debt issuance cost as a direct deduction from the related debt liability is consistent with the discussion in FASB Concept Statement Number 6, which states that debt issuance costs are similar to debt discounts and effectively reduce the proceeds of borrowing, which increases the effective interest rate. And debt issuance costs are not assets for the same reason that debt discounts are not, because the costs provide no future economic benefits.
And the presentation required by the new ASU will also improve consistency with IFRS. That's because IFRS requires transaction costs, including third-party costs and lender fees, to be deducted from the carrying amount of the financial liability and not recorded as separate assets.
That's right. So I think the changes proposed are fairly easy to understand. But it might be important to discuss what is not covered by this ASU. So, Brandon, if I were a preparer trying to adopt this ASU, what do I need to know about that is not impacted by this ASU? And have there been any clarifications of this ASU since issuance?
Well, the ASU is limited to simplifying the presentation of debt issuance costs. The recognition and measurement guidance is not affected by the ASUs. For example, guidance on debt issuance costs in accounting for conversion options or accounting for third-party costs of exchange or modification of debt instruments has not changed. What this means for preparers is that you will continue to track debt issuance costs separately from debt discounts as required by other accounting guidance.
Another point is that the FASB acknowledged that in circumstances in which there is not an associated debt liability amount recorded in the financial statements when the debt issuance costs are incurred, for example, the costs are incurred before funding is received, they will be reported on the balance sheet as an asset until the debt liability is recorded. But the board did not think it was necessary to provide explicit guidance on that because it observed that in practice entities defer issuance costs and apply them against the proceeds when they are received.
Well, that's interesting. So what happens then for line of credit arrangements? Will entities need to move debt issuance costs back and forth between assets and liabilities depending on whether they have amounts outstanding under the arrangement?
That's a good question, and actually one that the SEC commented on at the EITF meeting back in June 2015. Given the absence of guidance within ASU 2015-03, the SEC staff would not object to an entity deferring and presenting debt issuance costs as an asset and subsequently amortizing the deferred debt issuance costs ratably over the term of the line of credit arrangement, and that regardless of whether there are any outstanding borrowings on the line of credit arrangement. The FASB has incorporated this SEC guidance into the codification through ASU 2015-15 that was issued in August of 2015.
Thomas, when is this SEC guidance effective?
It's effective as of the SEC announcement date of June 18, 2015.
Okay, thanks, Thomas. With respect to effective dates, public business entities must apply the new requirements in fiscal years beginning after December 15, 2015, and interim periods within those fiscal years. Also, other entities must also apply the new requirements in fiscal years beginning after December 15, 2015, but they get an extra year and do not apply it to interim periods until those within annual periods beginning after December 15, 2016. All entities have the option of adopting the new requirements as of an earlier date for financial statements that have not been previously issued. Thomas, could you tell us about the transition provisions?
Sure. The ASU requires retrospective application to all prior periods presented in the financial statements. Upon transition, an entity is required to comply with the applicable disclosures for a change in accounting principle. And that completes the important information to know about ASU 2015-03 and ASU 2015-15. We would also like to inform you that you can find additional information on this ASU or other accounting updates issued by the FASB through our Defining Issues publications on the Financial Reporting Network website, which is also where you can find additional podcasts and thought leadership publications on a host of other accounting topics. Thank you.